Meantime, Deutsche Bank Private Bank CIO Deepak Puri and Invesco Chief Global Market Strategist Christina Hooper. It's great to have you both here on a green day for the major averages. Christina, I'm going to start with you because last week, just a couple of days ago on Thursday, you saw the S&P fall into correction territory. We've seen a lot of technical damage done and maybe some recovery there just off of that. You see index rebalancings and some expirations of contracts, including VIX this week. How much is that afoot in the market here versus the fact that it's been relatively quiet out of Washington?
I think being relatively quiet out of Washington, as well as the hope and potentially the promise of an FOMC meeting this week, which will not get a rate cut from, but we are going to get a dot plot. And that could give us insight into expectations for rate cuts this year. So I think that's one area of real positive surprise that markets could hold on to and put their hopes and dreams in. And so I think that's part of the equation today in terms of having a positive market.
Deepak, do you see it the same way here, especially given the fact, I think about Ed Yardeni wrote over the weekend, the fact that there doesn't seem to be a Trump put in this market. And we know the FOMC is going to sit on its hands, or at least the market's pricing in near certainty that the FOMC is going to sit on its hands this week. But to Christina's point, the forecast, the dot plot are really going to matter even more. Is there a Fed put in this market, and how much does it matter?
Well, thank you for having me. I think the Fed put might be similar to the Trump put, a bit out of the money for the time being, but that doesn't mean that the Fed cannot give some right signals. I think there might be talks and maybe an announcement of a pause in terms of the QT, so the runoff of the balance sheet. That might be positive, something that the market would like. I think in a sense, what's happening is that the market's doing its own cost-benefit analysis with regards to what's happening with the trade and tariff. And right now, the costs are a little bit, more extreme than the benefits, which might be in some time to come. And those costs are related to higher inflation expectations and lower growth. So unless something dramatically changes to that narrative, I think any gains that you see in the markets might be short-lived.
Christina, getting a little bit more granular, mega caps were up less today than the indices overall. As a matter of fact, NVIDIA, Amazon, Alphabet, Meta, all negative. Apple and Microsoft barely positive. Do you think NVIDIA's GTC this week changes the narrative at all for those larger stocks, or is this just a broadening that's inevitable regardless of that?
I think it's more the latter. My view is that valuations are very high among many of the mega cap stocks. And when there's a high level of uncertainty, investors are a lot more discerning and punishing when it comes to high valuations. You could also be seeing with this small and mid cap better performance part of a trade around expectations of Fed easing later this year. And keep in mind that it wasn't too long ago when expectations were that the Fed wouldn't give us any cuts this year. And that has started to change, and it certainly was helped by the CPI print last week. So my operating assumption is that small and mid caps are performing better because there is hope that we could get some easing from the Fed, which could be positive for the economy this year. And I think it's not just about the headwinds of tariffs. I actually think it's even more about the headwinds coming from Doge. Those cuts have a really big multiplier effect if we were to see them come to fruition in any kind of very significant way.
Okay. Well, Deepak, also performing better this year, European stocks. You say they are attractively valued. What sort of 5 to 10 year thesis do you need to have to feel like you should buy them here?
I think the first thing that has just happened, John, is that we did just get a 10-year thesis in terms of the kind of fiscal program that the German policymakers have, at least on principle, agreed upon. This is going to be at least 20% of their GDP going into the economy with regards to infrastructure spending, climate change, and so forth. So, that's 500 billion euros. This, along with the debt brake release of 1% of GDP on defense spending, I think you're talking about Germany really, cranking up in terms of their fiscal spending. And it's not Germany alone. France is doing the same. Other Baltic nations are doing it. So you're looking at a continent that has been left behind, post-pandemic with regards to their fiscal relief. And I think you're going to see a lot more of that to come. A quick question would be, which stock index has done better over the last 5 years, DAX or S&P? And, your viewers might be surprised a bit to see that the DAX has slightly outperformed the S&P over the last 5 years. So it's not just a story of this fiscal stimulus, those earnings have been growing. They were so beaten up, especially European banks, chemical, industrials, that you have seen a put there. And I think with this new fiscal spending, the story is just evolving.